A derivative is a financial contract, also called as financial derivatives. They derive their value from some other assets. Such assets from whom a derivative derives its value are known as underlying assets or simply underlying. Hello everybody, I am Vaishnavi and welcome to Allies Blue Online. In this video, we are going to learn all about types of derivatives. But before we learn about types of derivatives, let us find out what exactly a derivative is. Derivative means when a financial contract derives its value from some other underlying asset. As the price of the underlying asset changes, the price of the derivative also fluctuates. A derivative contract is set between two or more parties and is traded on an exchange or over the counter. Some of the common types of financial derivatives are futures, contracts, forwards, options, and swaps. Traders use derivatives to explore different markets and trade different assets. The most common underlying assets for derivatives are stocks, commodities, currencies, and market indexes. Now let's talk about types of financial derivatives. Derivatives are good instruments to operate in the stock market. Once traders get the hang of them, they can take positions and make handsome profits. There are several types of financial derivatives. Let's look at some of them with a few examples. First one is future derivatives. A futures contract is a legally binding agreement between two parties to buy or sell an underlying asset at a set price on a future date, which is also called the expiry date. A futures contract is executed directly through a regulated stock exchange. Futures derivatives are generally used to speculate in the commodity and equity markets. Some different types of futures contracts are stock futures. Stock futures are less than 20 years old in India. Trading in stock futures gives traders leverage. Futures are only available on a selected list of stocks. Next one is index futures. Index futures can be used to speculate on the movements of indices like the Sensex or Nifty in the future. Currency futures. A currency futures contract allows traders to buy or sell a currency at a specific rate against another currency at a fixed date in the future. Next one is commodity futures. Commodity futures allow traders to hedge against the price changes in the future of various commodities, including agricultural products, gold, silver, petroleum, etc. Next is interest rate futures. Now, this is a contract for traders to buy or sell a debt instrument at a fixed price on a fixed date. The assets are government bonds or treasury bills. Traders can trade these on NSE and BSE. That was about future contracts. Now let us find out about forward contracts. Forward contracts are similar to future contracts, but forwards are not traded through a regulated stock market. Hence, they are traded over the counter. This type of derivative is used for hedging. As they are over the counter contracts, that is OTC contracts, they do carry more risk for both parties included. Forwards have counterparty risk. It is a kind of credit risk where the buyer or seller may not be able to keep their part of the obligation. Therefore, if the buyer or seller becomes insolvent, the other party may not have a way to save their position. Few different types of forward contracts are windows forwards, long-dated forwards, non-deliverable forwards, and flexible forwards. First one is windows forwards. These are contracts based on the same logic as forwards. A defined amount is insured by a fixed rate of exchange, with the only exception being that the settlement date is variable. Next is long-dated forwards. Here, the settlement date is longer than 1 year and as far away as 10 years. Generally, most firms use long-dated forward contracts to hedge ongoing risks like currency or interest rate exposures. The next one is non-deliverable forwards or NDF. An NDF is a cash-settled, short-term forward contract. It is named so because the notional amount is never exchanged. Next is flexible forward. Also known as an open forward contract, a flexible forward is a contractual agreement to buy or sell a specified amount of one type of currency against the payment in another type of currency on or before the set date in the future known as the value date. That was about forward contracts. Now let us move on to options contract. Options are contracts that give the buyer the right to sell or buy an asset at a certain price on the expiration date of the contract or before that. The crucial thing here is that the buyer is under no obligation to trade the security. If the buyer does trade, then it is called exercising the option. Here are a few different types of options contracts. First one is call option. It is a facility that gives the trader the right but not an obligation to buy a security or an asset on or before the expiration of the contract at a fixed price. Second one is put option. It is a facility that gives the trader the right but not an obligation to sell a security or an asset on or before the expiration of the contract at a fixed price. Third is stock options. It has the shares of the listed company as its underlying assets. Next is index options. It tracks indices like Nifty and Sensex. Moving on to the next type of derivative, that is swap derivatives. Swap means to give something for something else or to make an exchange. When two parties agree to exchange their liabilities or cash flows from separate underlying assets held by them in order to hedge their risks, then it is known as a swap contract. Some different types of swap contracts are interest rate swaps. The objective behind this kind of swap is to shift the cash flow coming from a fixed rate of interest to a floating rate of interest and vice versa, so that the risk with respect to the interest rate can be hedged or speculation can be done. The next type is currency swaps. When two parties from different countries agree to exchange the cash flows in two currencies, then it is called a currency swap. The next type of swap is commodity swap. In a commodity swap, exchange of cash flows is based upon the price of a commodity. Well, that was everything about types of derivatives. I hope that it must have given you a brief idea about what derivatives are and their types. Thank you so much for watching. For more such informative videos, make sure to subscribe to Allies Blue Online. This is Vaishnavi signing off. I will see you in the next video.
Investment in securities markets are subject to market risks. Read all the related documents carefully before investing.